This is today's market comment here at XM.com by Mario Sajikiriakos. I'm Christina Marujos. A disappointing U.S. employment report inflicted some serious damage on the dollar last week. Non-farm payrolls clocked in at 150,000 in October, missing forecasts, while the unemployment rate ticked higher and wage growth continued to cool off. Hence, the U.S. labor market has started to loosen up, which is good news for the Fed in its battle against inflation. Looser labor market conditions translated into sharp losses for the dollar. Against a basket of major currencies, the dollar lost 1% on Friday as investors became more confident that the Fed has already delivered its final rate increase in this cycle. That gave traders the green light to buy bonds again, pushing U.S. yields much lower. While the dollar could remain under selling pressure for now, it is worth noting that every other major economy is weaker than the United States, so a full-scale trend reversal seems unlikely. Stock markets enjoyed their strongest week of the year as U.S. bond yields fell back to earth. The S&P 500 rose by an astonishing 6% in a single week, even despite disappointing earnings from Apple. The market is trading with a bad news is good news mentality, as the relief from falling yields has overpowered earnings concerns, at least for now. Gold is another asset that is supposed to shine in an environment of collapsing yields and a weaker U.S. dollar, but that hasn't played out. Instead, bullion lost ground last week, which is an alarming sign. The inability of gold to capitalize on the favorable developments in bond and FX markets suggests that safe haven flows are being unwound. It is becoming clear that the situation in Gaza is unlikely to escalate into a broader regional conflict, especially after Hezbollah leader played down the prospect of joining the war. The recent drop in oil prices tells a similar story. Looking ahead, the spotlight will shift to the Reserve Bank of Australia, which will announce its decision at 4:30 GMT on Tuesday. Markets assign a 60% probability for a rate increase following an upside surprise in inflation lately. Booming population growth, a tight labor market, and near-record home prices also pose inflation risks. A decision to raise rates could briefly boost the Australian dollar, but the currency's longer-term trajectory will be decided mostly by global risk appetite and how the Chinese economy evolves. Thank you for watching today's market comment here at XM.com. Have a great week.